Welcome to Chapter 3. This chapter introduces the adjusting process. The beginning of the chapter briefly describes the cash basis of accounting and includes examples of businesses that use it. The focus of the text is on the accrual basis counting. The basic idea of the matching concept was presented in Chapter 1, where expenses incurred were matched against revenues. Now in Chapter 3, matching is introduced formally and as a standalone concept. The matching concept is defined and discussed, and the chapter includes full coverage of the accrual basis. Of all the accounting concepts and principles introduced in the early chapters of the text, matching is the most important. Accountants use generally accepted accounting principles, also known as GAAP. The accounting period concept requires that revenues and expenses be recorded in the proper period. The revenue recognition concept and the matching concept require that revenue be reported when it is earned and related expenses be reported in the same time period. Some businesses use the cash basis of accounting. In this method, revenue is recorded when cash is received and expenses are recorded when the cash is paid. Small service businesses that have few receivables and payables may use the cash basis. At the end of the accounting period, a few accounts require updating. Expenses not recorded daily, revenues and expenses incurred as time passes, and revenues and expenses that are unrecorded are all accounts that need adjusted. These transactions are recorded at the end of the period prior to the financial statements being prepared and are called adjusting entries. Prepaid expenses, accrued expenses, unearned revenues, and accrued revenues are examples of accounts that require adjusting. After journalizing and posting the adjusting entries, an adjusted trial balance is prepared. This chapter ends with an explanation and demonstration of analyzing financial statements using vertical analysis. Enjoy learning about adjusting entries, and I will see you in Chapter 4.